Okay, so we'll take a look at Cematrix here, and this is a company. We were just at a conference in Vancouver where we were able to interview about 15, 16 management teams. One of those companies was Cematrix. And we also just recently received a question from a listener as well about the company. So I'm happy to go through and take a look here. Cematrix is a company that just recently uplisted to the Toronto Stock Exchange, TSX. Symbol is CEMX. The price is about 25 cents per share right now. And it has about 160 million shares outstanding, about a 50 million market cap or so. So, what does the company do? They're a company that manufactures and supplies cellular concrete products developed from its proprietary formulation, and they sell to infrastructure customers across North America. This is a unique cement-based material, provides thermal protection, and offers solutions for various challenges in the infrastructure, industrial, energy, and commercial sectors. So there are a lot of different use cases for the company's cellular concrete within the infrastructure space, from tunneling to highways to insulation and many more. But where they see their real competitive advantage in this technology is just the benefits that it provides their customers to utilize it. So they, based on the information from their presentation, it's about 40% less cost, 25% less emissions, also less uh, excavation, and also less trucking as well. So they say that it just makes sense, both environmentally and economically, for infrastructure companies to utilize their cellular concrete. And they see this as a major opportunity, as a lot of expenditure is expected to happen within the US infrastructure space. And that's really where they believe that they're well positioned. But let's take a look at the company's recent financial results. They put out their Q2 financial results not long ago. We can see revenue 6.4 million, up about 3%. Negative operating income minus 1.1 million. And then also negative cash flow from operations of $500,000, comparable to the second quarter of last year. So for the 6 month period, revenue is up 11% to almost 15 million. A good expansion in margins, and we did see some positive adjusted EBITDA and some positive cash flow from operations, but operating income was negative 0.8 million for the 6 month period, compared to negative 2.1 million for the 6 months in first 6 months of 2023. So recently, the company did announce that there were project delays that will be impacting their financial results for 2024. These were projects that were supposed to be delivered this year. Now they're expected to be delivered in the first half of 2025. So what this really does, it does set the company up for a strong first half for next year. So we would expect to see good growth in the first 2 quarters of 2025, assuming that these projects actually go through as planned at that point in time. But there's a bit of a flip side to that. So although the financial results should look very good in 2025 compared to 2024 based on these projects, when we now fast forward to 2026, they're going to have a hard time beating those numbers in 2026. So what we do see is some volatility in fluctuation from quarter to quarter and even year to year in financial performance from Cematrix. But right now, they are stating that they have strong fundamentals supporting growth going forward. Backlog of 84 million. They have a bid pipeline that they're estimating at approximately 450 million. They say they have 200 million US dollars in seasonally adjusted production capacity. So lots of ability to essentially increase production in order to meet demand. And they believe they're very well positioned to capitalize on US infrastructure spending. There's an estimated 550 billion that will be spent on roads, bridges, and public transportation in the US. But we want to, so, things look good. And I found from our conversation with the company, it was a very interesting conversation. I like the idea of a stock that is providing exposure to the infrastructure build in the US. And I like companies that have proprietary technology that with good, solid use cases. So it seemed to be the case, but we also have to look at the financials of Cematrix here and see, are these, is this technology, is it actually producing a business that is generating positive cash flow and good growth and strong fundamentals overall and fitting the Keystone model. So we'll start just by looking at revenue over the last 11 years. Now, I will say that the general trend in revenue is up. There is huge growth in 2023, 53 million in revenue compared to about 30 million in the year before. But we can definitely see there's a lot of fluctuation in revenue, on some years going up and some years going down. We see quarterly fluctuation, but recent revenue growth is strong, and the general trend does seem to be that revenue is moving in the positive direction. Unfortunately, we cannot say this about profitability. So the company has not managed to be able to produce consistent and meaningful profitability over time. 11-year history that we're looking at here, and in only 2 of those years was net profit positive, and all other years the company had a net loss. So we saw some profitability in 2023 last year, but only 1 cent. And then for the first 6 months of this year, negative earnings. So definitely not looking like the company is being able to drive a lot of the benefits of its business model down to the bottom line. And of course, they have bills to pay, and they need to offset those losses. And the way they've been doing that is by issuing shares. So a massive increase in shares outstanding over this company's history. We saw that begin in 2020, but really accelerate in 2021. And it's continued since then. So 137 million shares, weighted average shares in 2023, but that has increased again because now we're up to about 159. So we really like companies that are able to maintain a strong capital structure, meaning not too many shares outstanding, and also companies that aren't reliant on having to issue shares. We want to see that. We want to see the company. We want to see a sustainable business based on the company generating cash flow that it's able to not only offset any of its expenses, but also reinvest in the business for future growth and not being dependent on equity issues or debt. So we can see here from the 5-year chart that the shareholder return has really kind of reflected some of the issues that I've talked about. Very volatile stock performance over the past 5 years, really flat over a 5-year period, but a lot of up and down, and a huge downturn from 2021 to 2023. Now, the company just recently uplisted from the TSX Venture to the TSX exchange, and this happened in July. One might expect, and the idea generally is that an uplisting would be positive for a company share price. But they uplisted at about 44 cents, and they're now trading at about 25 cents. So we've seen a pretty significant drop here since that uplisting, and that likely has to do with the project delays. So looking at the company, our take, an upward trend in revenue, certainly recently, good growth in revenue. They should have that strong first half of next year due to those project delays. That is, again, assuming that the projects are actually started and completed in the first half of next year. And we think it's an interesting technology, and we like the exposure to the infrastructure boom, but the company really lacks meaningful and consistent profitability. The huge increase in shares outstanding over time is a problem for us. And we also expect financial performance to fluctuate from period to period. So we're not seeing profitability. We're not seeing a smooth trend of growth here, unfortunately. The company does not fit Keystone's model for investing, which would, of course, be a growing company where there's a lot of profitability being delivered to the bottom line. We will continue to monitor the company. It's certainly not something that we have any intentions of recommending in the near future. But if we could see it transition to more consistent and meaningful earnings, then it would be something that we would take a further look at.
Yeah. It's a company we looked at for years. They've had, positive outlooks in the past, but it's the history of weak profitability really that is in the business. Significant share count increases, and couple that with some positive outlooks in the past that hasn't necessarily translated into anything other than some revenue growth. It's great to see the revenue growth, but we need to see profitability. It looked like they were potentially on track for, a kind of a breakout year this year, but again, those orders were pushed forward into next year. So, I mean, we could see a positive. It should see a positive first half of next year, but can they again beat that going into 2026?
Mhm.
If you're just in fits and starts here, and more fits than starts, really, that is the issue. We just need more consistent profitability from the business, and it hasn't been there. Just based on the numbers, nothing to do with the technology. Looks interesting, and you'd think there would be further adoption, but it started to come. It looked like this year, but again, those project delays are hurting the business.